Russell on the typical format of webinars, and I also like him to be a little bit more lively. So certainly feel free to chime in at any time, and we can go in whichever direction we are interested in, and you're interested in going. Financial planning, I just wanted to sort of set the goal for today. And let me actually start by giving you a little bit more background on myself and our firm and how we work with people. So I'm the founder and investment manager of JPS Global Investments. We do money management, which is just as the term implies, managing people's assets, and also financial planning, which is really the sort of the bigger picture for people and helping them tackle the financial issues that they face in their lives and that can really move the dial for them. I have been doing this for a long time. My firm, JPS Global Investments, was founded in 2007. I've done some other things as well. I was a partner at Africa Capital Group, where we invested in sub-Saharan Africa. And that was an area where I really got to sort of kindle my desire to have impact and invest with my values, which informs some of my work today. And then at one point I was vice president of investment platforms at Franklin Templeton, was more of a traditional role, and that's really where I got my training, if you will. And then another thing that I'm proud of and hope to do more of in the future is I taught at the University of Oregon a class on impact investing, where I was teaching the students, and the students were teaching me about things that are important and impactful, and how investing can sort of unleash dollars in positive directions. So that's a little bit about me and JPS. And our goal for today is really, we're not going to solve anybody's specific financial problems. The details, I don't want to say financial problems, financial challenges. The details matter, and so, but what we are trying to do today is to really open up the question on financial planning, and it's like, where is this topic for you today? I know some of you, at least on the call, are business owners, and when you wake up in the morning, priority number one is to move the business along, and sometimes financial planning lands on a back burner. And so I want to make the topic sort of actionable for us today, and perhaps today or tomorrow they'll leave you with some next steps in terms of how you can really move the dial for yourself and get your finances on the right track, and if they're already on the right track, to maybe test or revisit some of the aspects of your financial life. So that is the goal. And I think the good news, and this is a quote that I truly believe in and always mention to my clients, is, when it comes to financial planning, you really only have to do very few things right in your life, in your financial life, as long as you don't do too many things wrong. And so I think I see it as a very positive and hopeful message. And if you can avoid some of the common pitfalls, I think you're ahead of probably 90+% of investors. So
Jan, what would you say are the common pitfalls? Because I might fall into one of those.
Yeah, sure, Russell. Well, so what are the big financial decisions in your life? For a lot of people, it involves real estate, right? So that's a big topic. Another one is saving, the savings rate. Like, it's the number one question: how much is enough? How much do I need to save? Do I, how much gratification can be delayed and deferred? What's the right number? So having some urgency around savings, making the right decisions around real estate, and of course, once you're building assets, making the right, avoiding some of the mistakes in how your money is managed. It's really easy to make some emotional and often poor decisions that put your portfolio years back. So we'll touch a little bit more on those things, but but those are just a few examples. So how do you feel about your financial life? Right? One of the reasons maybe it's a topic we don't want to deal with every day is because a lot of the emotions are not necessarily positive emotions, right? Perhaps we feel insecure or anxious, uneasy. I put some positive emotions in there as well. I didn't want it to be a fully negative slide, to be sure. There are people that feel great, in control, ahead, and confident. But a lot of emotions are sort of negative when it comes to finance. And I think, you may have heard the phrase that, well, people are more comfortable talking about their medical situation than about their money. And I think that's probably true. And that's an issue. This is an interesting survey that Chapman University does. It's the fear survey. So this is their 2018 version, and asked, what are you afraid of, right? And so I was impressed that number one was government corruption. It's kind of timely. Number 2 and 3 relate to pollution, but arguably at some level those are not necessarily things you can control, right? I mean, you can have some influence, but the first fear that you can really control is not having enough money for the future, and that one ranks higher to people than the 2 black bars that relate to loved one dying or becoming seriously ill. So that's a fact of life. And why does that matter? Well, it's the fear-induced procrastination, I guess, would be the reason that it matters. Because finances are hard to deal with, maybe not always number one priority. There's emotional dimensions to it, and people tend to put off kind of decision making around financial planning, financial issues. And I think the good news is it's never too late at any stage in life to start grabbing the bull by the horns and dealing with your finances and improving them. But it's also true that if you think of a decision tree, with the passage of time, the number of options just decreases. It's a pretty objective statement. So the sooner you can have an intervention, or the sooner you can revisit your financial trajectory, the more optionality you have, the more choices you have.
So Jan, in preparation for this talk today, I was doing a few calculations last night, and harkening back to my business school skills around present value and future value. And as I was future valuing, the power of compounding is so profound. I mean, the difference in 5 years between, say, the ages of 65 and 70, just 5 more years of compounding has an enormous impact on outcome. Sooner is better, for sure.
Yeah, no, absolutely. And I think we all know that. I'm not. Certainly, very little in my presentation is rocket science, but I think it's just good that we spend this time together to talk about it, because it is impactful. So I think when people think, well, what you mentioned financial planning, what's financial planning? Is that a 50-page document that you print out and give to me and I put in my desk drawer like my business plan and I never look at it again? It can be, and sadly, it is for a lot of people, but it shouldn't be. A good financial plan should be actionable, and it should, one size does not fit all. There's different people. It's not like preparing your taxes where it's just about the numbers. It's very much about the people. So I'm just going to give you a few examples to kind of illustrate that. So these are our clients. Their names have been protected here. There's some creative license, but I think a person that, and I don't use this in a condescending way. I think I'm certainly a procrastinator from time to time, but I think a common archetype client for us is Joe the procrastinator, or call him Jan the procrastinator. So this is just kind of what we talked about. It's important. You just don't get there. And so an example is a client that came to us and they're like, well, I have a pretty good job at a search engine company in Mountain View, I'm 55 and I want to retire in 10 years. And this person, by all measures, was doing well, or by most, at high income. But there was a real realization that, oh my gosh, even though I'm doing really well, my nest egg is smaller than it should be if I want to have the retirement that I want to have. So, but the fact that Joe was in our office and we're having a conversation was an acknowledgement that something needed to be done. So we really sort of put together a plan of like, well, let's first figure out, yes, your nest egg may not be the size you want it to be, but how much is enough? So we worked on kind of establishing a retirement budget for him. And we probably will come short of goal, but we have a much better sort of vision of where he's going, and we can be creative around his goal. His goal was to travel, and we just sort of redefining what travel is, can mean. And he has the confidence now that, yeah, he's going in the right direction, and he's going to meet some of his goals. But a very common situation, somebody, doing fairly well, maybe had never had to deal with finances in sort of in a stressful way, having a good job, and find themselves behind. Another sort of archetype client is Norman the Conqueror. The Norman is somebody that sold a tech company and did really well and has maybe a few $1 million, and he's looking for the next big thing. And so the conversations we're having with Norman is like, well, Norman, there's getting rich, which you were very good at, is different from staying rich. And so maybe for Norman, the best thing is not to find the next big thing, but maybe dial back the overconfidence and think more on protecting the assets. So we totally changed the paradigm for Norman's sort of approach to money going forward, and being more willing to think about holding on in terms of holding on to his wealth rather than trying to double it again. But it's a common mindset for people that have done well, is to sort of want to hit the next home run. Sally the Saver is a person that we come across a lot, and Sally is probably the most likely to be successful because saving is ultimately the fuel to creating wealth. And so good savers are, I think as a group, have the highest chance of meeting their financial goals, even if maybe they're not the highest earners per se. I mean, they can be, but there's really no substitute for saving, right? And so Sally's generally in a good spot, and the issues we deal with Sally can be more related to, okay, well, what's the right risk level for your portfolio? What are the right sort of tax strategies to sort of maximize your saving? But Sally the Saver is generally going to be all right. Cass U Matrice, he doesn't trust the stock market, and prefers to put all his money under the mattress, or in our case, in CDs and other sort of low risk short-term investments. That also a very common archetype client. And the conversations with Cass are all about, well, yes, we acknowledge your skepticism towards the stock market, and towards other maybe more risky investments and endeavors. But how are we going to get, going back to Russell's comment, the power of compounding? If you spend the next 5 years in neutral because you're afraid of the 2021 recession or the 2020 recession or whatever other dark cloud is on the horizon, it's going to slow you down in terms of getting to your goal. So a lot of conversations with Cass are around that, finding the right kind of risk level where he's comfortable but not too comfortable, because if you're too comfortable, you're probably floating downstream in a river. And if you're too uncomfortable, if something bad happens, you just won't be able to have the right reaction. So it's the sweet spot. Finding the sweet spot of discomfort is the challenge with CAST. So those are just some typical clients, archetype clients. So when you think of your personal financial journey, just like when you type in Google Maps, where you're going for your lunch appointment. Well, the number one thing is you start with is, where am I? What's my current location or address or what have you? So when you think of like financial planning, you really have to think of, where am I? Where's my business? Where am I? Where are my loved ones in terms of, am I responsible for a parent, a child that needs to go to college? Am I the sole breadwinner in my household? So where am I is very important. Where am I going? What are your goals? People say, well, I want to save for retirement. Well, okay, well, what does your retirement look like? What are you going to do? How are you going to pay for it? That is, of course, saving and investing. How do you get there? So it's called goals-based financial planning, but it's very important is to visualize the goal, and then to obviously have a plan to get there. And this is, again, not rocket science, but it's a very important exercise to go through when you tackle your financial world. And you have to play offense and defense. And what I mean by that is, for most people, probably up until their early 50s, their annual increase in wealth comes mostly from their savings. Just to give you a very simple example, say you're a 22-year-old and you have $5,000 that's your net worth, and you're able to save another $5,000 the next year, you doubled your assets. Whether the market was up 5% or 10% is less relevant. The fact you doubled your assets through saving, right? And so that formula for a lot of people tends to be true for a long period of time. So there is no, as we know, there's no get rich quick scheme, but there's definitely a get rich scheme, which is fueled by savings. So when you're young, you play offense, and at some level, you also hope that there's some financial crises or at least some turbulence in your future in the markets, because you're a buyer of investments. When you're a buyer, you want discounts. So it is not rational to be afraid of risk of sort of volatility in financial markets when you're young and saving and don't have the need for cash. So that's something to be aware of. But at some point, you're going to have to play more defense once you build up an asset. And then going back to the example of Norman the Conqueror, you have to start worrying about, well, how do I hold on to this valuable asset, right? And so, and that's when things like insurance and also investment strategies to be more defensive come into play. And this is sort of just building on, where are you? You can think of, in terms of your financial plan, where are you? Think of it in different dimensions. It's, for business owners, where is my business, right? Am I building it? Am I managing a thriving business? Or am I in a transition for my business? In personal life, am I single, in relationship, children, aging parents, et cetera, et cetera. So spending some time around where are you is very important. So the pieces of a financial puzzle or a financial plan, you mentioned the goals, your personal financial statements. And what I mean by that is, to know how much you need in retirement, for example, it's important to know how much you need right now, because you already have a certain lifestyle, certain desires, needs, interests. So for most people, their retirement budget is actually very similar to their pre-retirement budget. So if you know what your budget, your financial statement is today, right? Your budget, your cash flows, that's the number one input for figuring out how much you need tomorrow in retirement. So personal financial statements are important.
But Jan, you told me something very profound yesterday, which is, if you know what your target number is to live on, right, that you want to have budgeted, you should have a certain multiple of that in mind for the net worth nest egg that you want to build.
Yeah.
What was that rule of thumb? Because that like got me.
Yeah. Okay. So say, and I'm just picking a number because it's the easy math, not that it's anybody's budget per se, but say that in retirement, after considering Social Security, you still need an extra $100,000 a year to live the life that you wish to live. Well, that $100,000 needs to be funded. Just rule of thumb, right? Just keep that in mind. But multiply that by 25, right? So if you need an extra 100,000 beyond Social Security, you would need $2.5 million to kind of fund that. Now, maybe you won't get there. Maybe we get to 1.9, and that is okay. You can work with that, but it gives you sort of at least sort of something to hang on to and say, okay, well that's a baseline, right? And it's not, life will be okay without hitting it, but I need to have some context. So I think that's a helpful context, rule of thumb.
Right. I mean, if 25x, if 25 times is your target output, like now you at least have a North Star. So now if you work backwards and start figuring out, okay, well, how much do I need to allocate each year in service to getting there, you can start building a plan toward that. That was a very profound metric for me, which I really appreciated. But I have a question for you. I'm a business owner today, and I certainly expect that the cash flow from the business will continue to grow and will be able to service me and my family. But what if I don't really have a lot of savings ability today? Should I be nervous? Should I be looking for should I be running a side gig, like generating revenue elsewhere? Like, what's the level of, how do you manage anxiety?
No, you're exactly right. And I'm also a business owner, and I also have anxiety around the fact that my biggest asset is my business, right?
Yeah.
So, and it feels really difficult to not reinvest in the business, but reinvest outside of the business, right?
Mm-hmm.
So I feel like I don't have a lot of extra savings because I decide to expand my business, but I am right now reminding myself that I should think of a plan B, because to the extent that, and I think that's where a company like Russell, like Stride is very, very important and helpful. Is like, if I was, as a business owner, confident about the cash flow picture of my business, and I would be less, if I had better visibility, I'd be less inclined to always reinvest in the business and be more inclined to take out some money, whether it's spending it on myself or building my plan B. But yeah, I think, speaking as a business owner, I think that savings is always a challenge, and you can rely very much on your biggest assets, which is your business, which is an extremely illiquid asset, right?
Right. Okay. And so Brian, my good friend at Look Left, he asked a question here, which is, what strategies exist specifically for business owners to to maximize their savings or investment, like SEP IRAs, et cetera? What kind of guidance do you kind of give around that?
Yeah. And let me skip ahead a little bit.
Yeah, that sounds good. And by the way, guys, Brian asked that question in chat. So if you have a question and you don't want to just speak up, which you should do, by the way, you can always put it in chat, and that's cool.
So there's actually, so these are some issues that entrepreneurs face, and I'll touch on retirement as well, and I think that will get to the question a little bit. So being a business owner actually gives you some optionality that you don't have when you work at Norman the Conqueror's search engine company in Mountain View, meaning you can decide on your own retirement plan. You don't have to go with what is offered. And so when you think of like, well, for my business, should I have a 401k? Should I have a pension plan? A pension plan is like what the old Ford, General Motors, GE used to offer to their employees. It's basically guaranteeing lifetime income to your employees. It's actually available for small businesses, and it's not as crazy as it sounds. But so you have to really think about, well, what's the goal for my retirement? Am I trying to maximize the dollars that go into there? Am I trying to, is it just for me? And I don't mean like me, selfish me. But is the goal to maximize my retirement assets, or is the goal to also offer a benefit to my employees as a key retention of employees, attracting good employees? So you have to sort of answer some of those questions. And what's the structure? If you have a lot of employees, maybe the 401k is not the best choice, because especially if your goal is to maximize your own retirement savings. And so there's a lot of kind of questions you have to answer, and that will guide you to one or two choices. And for most people, it ends up being a SEP IRA, which is Simplified Employee Pension Fund, or a 401k. Those are the most common ones. But for like a doctor, sometimes that maybe they have a clinic with just a couple support staff, and they have a very predictable business. They can have a pension plan where they could put $60,000-$70,000 a year into it, and it stays inside the company, but it's also ultimately funding their retirement. So there's a lot of choices, and it really depends on what's your goal, right? What's your goal and what's your business structure, and then you choose the plan that best fits that. I hope that helps.
Yeah, Jan, if you have your own LLC, and let's say you're doing some consulting work, like I know Margot does some consulting work, who's on the call, is the best vehicle, retirement vehicle or savings vehicle, a SEP IRA for a single member LLC in your view?
I would have a bias towards the SEP for the plain reason that it's simple and cheap.
Simple and cheap.
Yeah,
got it.
It's simple and it's cheap, and you are contributing. So it's an employer funded plan, right? So a 401k, employees put money in, and then maybe the company matches. The SEP is all on the employer. So you just want to make sure that that's a good fit, right? But it could very well be a good, for consultants, it's generally a really good one. But you also want to think about how much do I want to put away, because they're like different plans have different limits. And so, yeah, if the SEP, if you're not hitting the limit of, what you want to put in, then that would be a really easy way to go, because it's easy to administer, it's cheap. It's, good choice.
Okay. So, yeah, no, it's good to know. Okay.
So I think in the interest of time, I was going to sort of skip forward a little bit to talking a little bit about investing and kind of our big philosophy of mistake avoidance, going back to Warren Buffett's quote, is if you can not make too many mistakes, then you're a better investor. Unless we want to spend some more time on kind of the entrepreneurial issues.
Brian, did we answer your question okay? You have any follow-up? I'm good. Okay. He's good. All right.
Okay, so just before we just kind of pivot.
Yeah.
I think for entrepreneurs, just that in a nutshell, one of the things you want to think about is, how do I de-risk my life? Because I'm all in on my business, right? So obviously de-risking your business is, having the right key woman insurance, key man insurance, whatever it may be. Think about things like disability insurance. We just did disability insurance for a doctor, and she already had it, but turned out her disability insurance in the fine print said, we only pay out if you can't do any work of any kind. And she said, well, I'm only interested in being a doctor. I don't want to be a cashier at Target. So I said, well, I think that policy is not going to do it for you, because it's saying, like, if you can still do that, we don't pay you out. So, but anyway, so think of insurance, de-risking your business. building equity. What does that mean? Well, if you sold your business today and the buyer would then turn around and hire you to run it, would there be any profit left beyond that? If all the value is your paycheck, then you have zero equity basically. So you want to think about, how do I make my business valuable beyond me, the professional working in it? I think it's a very important thing to think about. Creating exit strategies. I mean, we could spend hours on that, but key takeaway: start 10 years before you, or longer before you want to sell your business. That would be ideal, because these things have a glide path, and you know, the earlier the better. But let me skip forward a little bit. So we talk a lot, you know, financial planning. Like, my background and passion is on the investment side, although it's more and more on realizing that the holistic big picture is what people really care about, and where we can add the most value. But I think it's also important to just look at this graphic and realize, like, when you think about your financial life, it's not like, oh, what should I invest in to get rich? No, that's just a subcomponent. It's like all the other stuff that's actually really important. But I do want to spend some time on investing and to tell you a little bit about how we approach it. So this is the only math in my presentation. I had more, and my colleague Tara told me to take it out. So
yeah, good idea.
So how much should you expect from your investments, right? In your 401k, in your brokerage account at E-Trade, whatever the case may be. Well, your return, your results are always a component of these four things. It's a pretty universal formula. So what are you going to earn on your investments? You're going to earn dividends. So call that, and let's use maybe a U.S. stock as an example. 2% dividend. There's some growth, right? So next year, Target is going to sell more Halloween costumes than this year, right? So more growth, more profit. So throw in an extra 3%. Now you're at 5, right? Item number 3, discount. If we're in a recession, Target stock is cheaper. So if you buy a house during a downturn, it's cheaper. So that discount ultimately is going to give you an extra bit of return, right? So in today's world, I think the discount is 0, maybe negative. So okay, so now you're at 5. The discount was 0, and this is the real game changer. Is the behavioral gap. So that is where we don't make the right choices, and therefore our return is going to lag what it could have been. So that's the behavioral gap. So sadly, that is on the same order of magnitude as some of the other factors. So maybe it's -2, right? So anyway, but that's how you sort of think about, like, how much money am I going to make? And let's just go forward. Now, this is getting really technical, but
so just so I'm clear, the behavior gap is what I get enamored with a exploratory oil drilling company in Texas or something, like it's emotionally driven. Is that behavior gap?
Yeah, exactly. You notice that your intern is minted $1 million in Bitcoin, and you feel really stupid that you didn't catch it on time. But it's never too late, and now you put 20% of your portfolio into it. That's the behavioral.
That's the behavior gap. Okay, got it.
And it's real.
Sure.
And now this slide is maybe there's a little bit more math than I thought, but on the horizontal axis you have volatility, so how risky something is, and on the vertical axis you have return. And so what most people do, this is also part of the behavioral gap, is they look at what has done best. So they invest in the past and they put all their money there. So if you look at the little red dot, it's U.S. stocks. So our return expectation for that is low, because we think the future is not going to match the past. So if you're able to invest without looking in the rearview mirror, you probably will do better. But it also means you have to put your money in different things than other people, because most people invest in the past.
Is EM emerging markets?
Yeah.
Okay. And what's EAFE?
Europe, Australasia, and the Far East, I believe.
Got it. Okay.
And the little pink dots are private equity. That, if you're curious,
Okay.
I couldn't label all of them.
Oh, you mean on the far right there?
Yeah.
Oh, okay.
And when then people will say, well, I hear you on emerging markets, but look at how bad it's done. Look at what's going on in Hong Kong. Look at what's going on in Chile, Venezuela. I'm just not going to do that. And it's like, well, it's also one of the reasons that those stocks are cheap, and that you may get paid for doing that. So that's
yeah.
So investing is about understanding that you know what's under the hood, I think. So the reality is that stocks move like the first bar there, they're volatile, bonds are less volatile, and cash is less volatile. And typically that means you get rewarded more for owning the stocks than the bonds. But of course, there's periods of time where maybe the price is not right. But if you think of is my portfolio right for me? Well, the number one thing I would look at is, well, how much of your portfolio is in stock? And that's your risk speedometer. So if it goes from 0 to 100 and you're all in stock, you're at 100. So just, if there's a 30% correction at some, which is rare but not inconceivable, then you're probably going to go down by about that much. So that gives you a sense of scale, and then you go from there. But it's not like I want to invest in stocks, but I prefer the ones that aren't risky. Now it's the nature of the beast. So something to keep in mind. So going back to the behavioral gap, like how big is the behavioral gap, right? So there's a company called Dalbar, and they do this annual study of investor behavior. You can find it if you Google it. And so they looked at what people that invested in U.S. stocks, how they did over the last 10 years. So the bogey is the U.S. stock index, right? So over the last 10 years, investors earned, call it 5, and the market 8.5. Now, 1% of that maybe goes to overhead, right? If you hire us, and you buy some mutual funds or something like that, maybe you can't quite get to 8.5 because you have some cost. But probably 2/3 of the gap is actual investor behavior. And it's unfortunate because all you have to do is buy the index and never look at it again, right? But people, experience the behavioral gap.
So given that, Jan, just to challenge your strategy at JPS, should we just be putting our investment in funds, in index funds, or are you trying to beat the market, or are you trying to meet the market with a values-based approach? Like, what's the?
Yeah, I think I am trying to meet the market, and if we exceed it by making some unique, thoughtful investment decisions, then I'm very happy.
Got it.
The bogey is to meet it, and the bogey is to meet it with our values.
And meet it net of fees, ideally. Yeah. Got it. Okay.
So why do we have this behavioral gap? Well, let me skip forward. I could simply say, well, because we are motivated by greed and fear, and we buy and sell at the wrong times, and then we do that over and over until we have no money left. But why? That doesn't tell you why we do that. Not really. So these are the behavioral mistakes we make that lead to that type of behavior, right? So you want to get to the root cause. Loss aversion, right? We are afraid of losses. So that leads to two types of the bad decisions. One is an investment that's doing just fine. We sell it because we like the fact that we're at a gain and just want to cash it out. That's actually loss aversion. You have to think that through a little bit, but it's by locking in a gain, you've avoided a loss. but a loss aversion also, obviously, the more common example is on the downside, right? So it's like, oh, everybody told me that Beyond Burger was like, that animal protein is going to replace regular plant protein is going to replace animal protein in burgers, and it's great. And I bought the stock at 150 after it was already doubled, and now it's 100. But I believe in this company. I'm going to hold on, and then next week it's 80, and at some point I just can't take it anymore. And because of my loss aversion, I sell it, right? So loss aversion works in both directions. Herd mentality. Just go back to the Bitcoin example. But another herd mentality is, everybody's talking about the upcoming recession, right? And yeah, there will be a recession, and it could be better. It could be a bad recession, or a moderate recession, or a mild recession, and it could happen next year, or the year after, or the year after. So if everybody's talking about it, there's probably very little benefit you derive from trying to do something about it in your investment portfolio. So if you're de-risking your investment portfolio to get ahead of the recession, you just want to think that through really carefully, because what kind of tax impact are you going to have? How are you going to get back in? If your portfolio wasn't recession proof to begin with, was it the right portfolio, right? So knowing something everybody knows doesn't generally help you make, sort of smart market timing decisions. FOMO. I experienced FOMO in the Bay Area, fear of missing out, right? I mean, my real estate friends tell me, this 2019, this is your last chance to get a house, because all the IPO money is just you're gonna be out forever, right? If you don't own one right now. So there's this fear of missing out, I think, that motivates a lot of us. And eventually we overcome the fear by jumping in, right? So a lot of these things are entirely related, by the way. Overconfidence is I have a client who's a chief scientist at a biotech company, and her record of picking biotech stocks is not good. And she self-admit that. I don't say that of her. She said, but there's this natural overconfidence that you know what you're talking about. I understand this, right? Recency bias is you think what happened in the recent past is going to keep happening. That's driving our poor asset allocation, right? Putting too much money in U.S. tech stocks. Familiarity bias. I'm more comfortable investing in Netflix than in XTR company in France, because even though maybe they do the same thing, I know Netflix, and so that has to be a better thing. Anchoring is a very dangerous situation where you attach meaning to where you bought something, right? So I had a client who worked at a cybersecurity company called FireEye, and the stock was at close to 100, and he had heard from the CFO that stock was going to go to 120, and the stock went the other direction, but he said, I can't sell until it gets back over 100, because he was anchoring the 100 as if it had any meaning, which it doesn't. So anchoring is a very dangerous thing. So we're not rocket scientists. We don't think finance is all that complicated, but what we do spend a lot of time on is becoming less emotional about investing, and it is also easier to be unemotional about other people's money. And I don't say that in a cavalier kind of way, right? But sometimes it's just helpful to have somebody else that doesn't have the same emotional investment in your finances to take a look over your shoulder. So we think that if you can deal with some of these issues, and you can be a much better investor, that's our life's mission, to work with you to figure that out. And then we strong believer since the founding of JPS in investing with your values. So you read financial media and other media, you might come across different terms like impact investing or SRI, which is socially responsible investing, or ESG, which is screening on the basis of environment, social issue, and corporate governance, the G for governance. They're all the same thing in a sense. It's investing with your values. It's something we believe in strongly. And the good news is it's getting easier and easier. Like 10 years ago, unless you were an institutional investor, you're pretty much stuck with mutual funds. And they were generic, meaning like, yeah, we screen on all those things, but we can't really tailor it to your specific values. And it's much easier now to build portfolios for clients of all sizes, incorporating their values because of the technology that allows you to replicate indexes and screen in and out companies without having to buy mutual funds. This is the number one question I get when we talk about socially responsible investing. It's the 800-pound gorilla, which is an extremely obese gorilla because gorillas weigh apparently between 300 and 400 pounds. But lagging performance. It just doesn't, conceptually, it only makes sense that you would have to give up something by investing with your values. And maybe that's okay, but that's conceptually what most people think, right? So I can answer that very simply by saying, no, that is not true. So this chart goes back to 1991 and it shows the S&P 500, which is a proxy for the US stock index. That's the blue line. And the yellow line is the KLD Social 400 index of socially screened stocks. Now, to be sure, these companies aren't necessarily saints, but they're sort of better choices, if you will. There's two things that should jump out. One is, oh my gosh, the lines are pretty much on top of each other, right? So that means, yes, you are correct. You can actually invest with your values and get a very similar experience in terms of volatility and such. Two, the yellow line ends up above the blue line, right? I don't actually attribute any meaning to the differential. I would just say but what I would say is there's no penalty for investing with your values, because where's the penalty, right? So we believe that. Now there are situations, and I always mention this in my impact investing class at the University of Oregon. There are investors who are what you call impact first, right? Meaning that I care mostly about impact and secondly about financial return. And there's certain investments that fit that profile, right? Where you're like, yeah, I'm maxing the impact and I'm okay with below market return. But it doesn't have to be. A lot of impact investors are what they call market rate or return first. So they maximize return with the constraint of avoiding things they don't want to invest in. So who are you as investors is another question to ask there. But anyway, so I know I've talked a lot more than I thought I would.
A lot of material. It's okay.
So I'd be remiss if we skip the key takeaways. I think number one is probably it's never too late. At any stage in life, you can move the dial, right? Yeah, it's wonderful if you're early on that decision tree and you still have all this optionality, but it's never too late. You can always improve and make changes. You need to know where you are and you need to know where you're going. You can invest with your values and do well. What are some of the next steps that you might take, right? So I think one is take an inventory of your financial situation, right? Where are all your assets? If the goal is retirement, how big is your nest egg, right? I mean, it's a good metaphor. That's number one, right? if other people factor into the equation, do you have an estate plan? Do you have a medical directive? Do you have, all these sort of things that are extremely important? And sadly, we see what can happen when people don't have those things, right? Because we work with so many people, and not every story has a happy ending. A lot of stories have happy endings. Not every story has happy ending. So those types of things. And then try to answer the question: how much is enough? Right? Are you already set? Like maybe you already have enough to fund your retirement, and you can dial back on the risk and even retire early. I mean, why not? Right? So you need to understand your finances. You need to understand your business finances, right? Stride. Understand your cash flows. Understand your KPIs. What's moving the dial for your business. So some next steps is that's where I would start, and seek out the help of a professional. A professional is really a partner, and I'm borrowing this phrase from Russell because I know it's so good. Like you need to be in your genius zone, and so work with other people that can be in their genius zone and be collaborative. Right, you get more done, and Russell is a good reminder to me too. Right, I have the tendency to do too many things in house, but in my field, folks like myself generally give you a free evaluation, right? So don't fear the sales pitch, but maybe get a second set of eyes on your finances would be another takeaway.
That is terrific, Jan. And Margot asked a question about, hey, I'm pretty early in my business and it's pretty lumpy and it's pretty uneven. Are there some resources out there? What came to mind for me was, one, just have a conversation with you. That could be super helpful. Number two is just get some of these instruments in place. Like the cost of putting a SEP IRA in place is like zero. I set one up last week, and I mean, it was super easy. So just attach it to your LLC and just know that vehicle is there, and just start putting a little bit of money to work. And as you get more understanding and experience for the velocity of what you can put away, at least the vehicles are there and set up for you. At least that was my thinking when I did it.
Cool. Thank you. Work in progress.
Yeah. Well, listen, I know we're at time, and I want to respect everybody's time. Jan, thank you so much for laying the groundwork. Like, I feel like that's what this call was. It was laying the groundwork to start asking ourselves questions and putting a plan in place, which I really appreciate. I think having a conversation with you at JPS makes a ton of sense. And you all know, those that signed up know what we do at Stride, and what we're trying to do is make sure that business owners can go to sleep at night with trust and confidence that their finance and accounting is being well managed, so they can actually spend time on growing their business and creating wealth and equity value. So with that, I think we're going to sign off. And again, Jan, thank you for your time. And this will be on the blog in the next 72 hours. Have a great day, everybody.
Thank you so much.
Thank you. Bye-bye.